In 1929, thousands of ordinary Americans stood in the Florida Everglades holding paper deeds to land they'd never seen, convinced they were minutes away from becoming wealthy. Nearly a century later, you can repeat the same mistake without ever leaving your couch, by putting $100 into the best 3 index funds while believing you're safely diversified. This story is the case file that exposes how fortunes quietly vanish, not from stupidity, but from a perfectly reasonable plan you don't fully understand. If you want more investigations like this, where we dissect money, psychology, and the traps nobody warns you about, hit subscribe right now. Because what you're about to hear will change how you look at every safe investment. I keep a private rule as an analyst: whenever a crowd says an investment is guaranteed, I treat it like a crime scene. The Florida land boom wasn't built on dirt, it was built on language. Next, Miami Beach, only going up, limited supply. People weren't buying land, they were buying relief from uncertainty. And when you buy relief, you usually overpay. The developers knew it, the bankers suspected it, the buyers didn't want to know it. That's the first pattern. The victim isn't the person who lacks intelligence, it's the person who craves certainty. Second pattern is uglier, because it hides inside things that are genuinely good ideas. Index funds are one of the greatest financial inventions in history. Low cost, broad exposure, simple, but crime doesn't need to invent a new weapon when it can borrow a trusted one. The modern version of swampland isn't a shady land deed, it's the story that 3 index funds automatically equal safety. The trick is subtle. You can be diversified on paper while concentrated in reality. And your emotions don't notice the difference until the damage is already done. Let me introduce you to our first character. Daniel, 34. Owns a small business and sold it at the right time. After taxes, he's sitting on $100. He tells himself he won't gamble, won't trade, won't chase meme stocks. He wants boring. He wants mature. He wants the kind of plan you can explain in one sentence at a family dinner. So he does what every book, advisor, and influencer says is responsible. He splits the money across 3 index funds: US TotalMarket, International Developed, and Total Bond Market. Clean, elegant, grown up. Ellipse believes he's buying thousands of companies, thousands of bonds, the whole world. He's not wrong, technically, but technical truths are how modern money myths survive. When I audit his allocation, I don't start with the fund descriptions. I start with the holdings. Because the holdings are where the fingerprints live. And that's where Daniel's first shock appears. A massive chunk of his entire market exposure is quietly concentrated in a handful of giant tech names that behave like the engine of the portfolio, until one day they behave like the anchor. This is where the restaurant analogy becomes more than a cute metaphor, it becomes a diagnosis. A restaurant can have 30 menu items and still be dependent on 7 dishes for 80% of revenue. A market index can have 500 companies and still be dependent on 10 stocks for a giant slice of performance. If those 10 stumble, the index doesn't politely diversify the pain, it concentrates it, and because the concentration is wrapped in the comforting word, index, most investors don't emotionally prepare for what it feels like when their broad market suddenly behaves like a narrow bet. If you think this is a new problem caused by modern tech, you're already in the trap. In the late 1960s and early 1970s, Wall Street built a shrine to certainty called the Nifty 50, blue-chip giants that were treated like immortal beings. Xerox, Polaroid, Kodak, Avon, companies that felt as permanent as gravity. Institutions paid insane valuations because they weren't buying earnings, they were buying comfort. Then the market cracked, and the comfort premium turned into a discomfort tax. The lesson wasn't that those companies were fake, it was that even real giants can become dangerous when everyone agrees they're untouchable. My notes, I call this the myth of the unlosable asset. Florida land was real. Nifty 50 were safe. Today the myth wears a calmer suit. Just buy the S&P 500. Or, just buy 3 funds and chill. The myth always sounds like wisdom because it contains a truth. Real estate can build wealth. Blue chips can be strong. Index funds can be powerful. But when a partial truth becomes a complete story, it stops protecting you and starts controlling you, because it makes you stop asking the only question that matters. What am I actually exposed to when things go wrong? Now the investigation turns from math to motive. Who benefits when Daniel never looks under the hood? Not a shadowy conspiracy, just incentives that lean in one direction. Fund providers earn more when assets flow in smoothly and stay. Advisors earn more trust when the plan sounds simple. Media earns more attention when the story is clean. Nobody gets rewarded for saying, "Yes, this is good, but here are the uncomfortable details about concentration, valuation, and what you'll feel during a 40% drawdown." The system doesn't need you to be completely ignorant, it only needs you to be confident enough to buy. And confused enough to panic later. Because here is the cruel part. This is the moment most people never rehearse. Daniel checks his account after an ugly year and sees $100 become $72. It doesn't feel like a normal fluctuation. It feels like a personal failure. It feels like a trap snapping shut. And his brain does what brains evolved to do. It tries to stop the pain by taking action. That's when the real theft happens, not from the market, but from his own hands. The market can recover without him. The only move that makes the loss permanent is the move he's most tempted to make: selling in fear. Right before the story flips again. I've watched this exact moment happen to smart people who swear they're rational. The first time you see a 5-figure loss on a safe plan, your mind starts narrating danger like it's an emergency broadcast. You don't think, "This is volatility." You think, "Something is wrong." You imagine a hidden flaw you missed. A leak in the boat. A future where you'll be the idiot who didn't get out in time. The market doesn't have to chase you. Your nervous system does the chasing for it. This is why I call early investing a psychological hazing ritual. Years 1 through 5 aren't hard because the math is complicated. They're hard because your portfolio is still small enough that every drop feels like it's eating your life. 10% down is not a percentage, it becomes a car repair. A family trip, 3 months of groceries, a month of rent. The numbers don't just shrink, they transform into memories and necessities. And the more you attach the money to your identity, the more the volatility feels like an attack. Florida victims didn't just lose cash, they lost dignity, certainty, and time. The land itself didn't punch them, the story did. The same is true with index investing when done blindly. Because the real damage isn't a temporary drawdown, it's what drawdowns make you do. Panic selling doesn't feel like giving up, it feels like taking control. And that's why it works so well as a trap. It disguises self-sabotage as self-rescue. Allow you to notice something subtle in Daniel's plan. It's correct on paper. A U.S. total market fund, an international developed fund, and a bond fund is basically the default blueprint of modern retirement systems. Robo-advisors recommend it. Target date funds implement it. Personal finance books praise it. That's exactly why it's dangerous to treat it as a magic spell. When millions of people follow the same blueprint without understanding it, the blueprint becomes a crowd trade. And every crowd trade, no matter how sensible, has a moment where it tests the crowd's nerve. What any investigator would do. I reconstructed the crime before it happened. I ran the timeline forward in my head as if it were already history. I imagined a familiar pattern, an inevitable storm, the kind Tom hinted at in the story. Something knocks the market down hard. Headlines scream recession. Tech earnings disappoint. Interest rates refuse to cooperate. Liquidity dries up. It doesn't matter which spark starts the fire. What matters is that Daniel's diversified portfolio suddenly moves like a single animal. That moment, Daniel will discover a truth that feels unfair. Diversification doesn't mean you can't lose money. Diversification means you can survive long enough to recover. It is not a shield. It is a seatbelt. The seatbelt doesn't prevent the crash. It prevents the crash from ending you. But you have to keep it on. Taking it off mid-impact is how you turn a survivable event into a catastrophe. This is where sequence of returns risk enters the story like a silent killer. Two investors can get the same average return over 5 years and end up in completely different places depending on when the losses show up. If Daniel gets hit early, year 1 or 2, his confidence fractures before compounding has time to build a cushion. If the losses show up later, when his portfolio is larger and he's emotionally seasoned, he can endure it. The market doesn't just test your strategy, it tests your timing in life. I've seen people misread this and come to the wrong conclusion. They say, index funds are a scam. The same way Florida victims said, real estate is a scam. But the scam wasn't the asset class, it was the story of inevitability. Index funds don't promise you a straight line upward. People do, advisors do, indirectly, charts do, with their smooth long-term curves. Your brain does, because it hates uncertainty. And when reality refuses to cooperate, your brain looks for someone to blame. Here's the twist. The biggest edge in this entire game is not smarter fund selection. It's behavioral discipline, what academics sometimes call behavioral alpha. It's the return you earn by refusing to do the stupid, natural, human thing. Most investors underperform their own funds not because the funds are bad, but because investors buy after the good years and sell after the bad ones. They donate returns to fear and greed. Over decades, that donation becomes a fortune. I once modeled this for a client in a way that made his face go pale. Same funds, same market, two outcomes. Investor A stays invested and captures the fund's full return. Investor B panics twice, only twice, selling after deep drawdowns and buying back after rebounds. The difference over 30 years wasn't a few percent. It was a different life. One ends with security, the other ends with regret dressed up as, "I played it safe." That's the most brutal irony. The investor who panics believes he's being cautious, but he's doing the one action that guarantees a weaker outcome. Now we zoom out from Daniel's account balance and look at the larger machine. Because every good investigation asks a second question: if this trap keeps repeating across generations, what keeps resetting it? The answer is simple and chilling. Memory fades faster than markets do. The pain of the last crash disappears, and the next story fills the space. People don't inherit lessons, they inherit confidence, and confidence is the raw material bubbles are made from. A Florida swampland didn't just sell because it was cheap or plentiful. It sold because it was emotionally convenient. It offered a shortcut past years of slow saving. The Nifty 50 didn't become a religion because investors loved spreadsheets. It became a religion because it promised relief from decision-making. Buy once, hold forever, no doubt, no anxiety, no messy uncertainty. Today, 3 index funds can become the same psychological drug if you treat them like a guarantee instead of a tool. This is why I don't begin with returns when someone asks me, "What if I invest 100K in the best 3 index funds?" I begin with identity, because money doesn't just grow in accounts, it grows in minds. Daniel doesn't want to be the kind of person who gets fooled. He wants to be the kind of person who's disciplined, rational, and ahead of the curve. So the plan becomes more than a plan. It becomes proof of who he is. And that's the moment danger enters. Because a threat to the portfolio becomes a threat to the self. The next character in our case file is Maya, 29. High income, high stress, and extremely online. She's not holding a deed to swampland. She's holding an app that refreshes price charts with the flick of a thumb. Maya also chooses 3 index funds. But she carries a hidden weapon that Daniel doesn't. She contributes monthly. She's in the accumulation phase. And here's the paradox she doesn't understand yet. During accumulation, crashes can be gifts. They let you buy more shares at lower prices. The same event that terrifies retirees can enrich workers if they keep buying. But the paradox has a blade on both sides. Crashes are only gifts if you're not forced to sell. That means your real safety is not the fund selection, it's liquidity, stability, and time horizon. If Maya loses her job and must liquidate during a downturn, the crash becomes a trap, not a discount. This is the part that never makes it into viral financial advice. The market doesn't just price your portfolio, it prices your life's flexibility. Why I segment money like an investigator separates evidence bags. Not because it's elegant, but because it prevents contamination. Money you need in the next 1 to 3 years should not share a room with money meant for 30 years. When those two piles mix, you end up with an allocation that's too risky for your short-term needs and too timid for your long-term future. You don't get the best of both worlds. You get the worst. Anxiety now and regret later. Tom's story hinted at something most people avoid because it feels too technical: inflation. The day Daniel hears, your $100 becomes almost $1.000 in 30 years. His brain paints a picture of yachts, freedom, and a clean exit from stress. But that picture is drawn in today's prices. Inflation is the quiet counterfeiter that changes what the number means while you're staring at it. $1 million in 30 years may feel like a different animal than $1 million today. The number can rise while the sensation of being rich stays stubbornly distant. What I call the $1 million mirage. People hit a big nominal milestone and feel underwhelmed. They expected fireworks. They get a slow, confusing shift in comfort, and when reality doesn't match the fantasy, they're vulnerable. That's when safe investors become gamblers. They start reaching for leverage, hot sectors, single stock stories, Anything that promises to restore the emotional thrill the milestone failed to deliver. The market loves that moment. It's where discipline dies with a smile on its face. Oh, the most controversial part of the file: international diversification. Even smart people disagree here. And that's exactly why it matters. There are years, sometimes decades, when international drags behind US stocks and feels like dead weight. In those periods, international allocations look like a mistake. People abandon them at the worst time, right before the rotation arrives. The reason diversification works is also the reason it feels wrong. It disappoints you until the day it saves you. The deeper truth is that diversification is not designed to maximize your happiness. It's designed to maximize your survival. It's a probability tool, not a dopamine machine. If you need constant confirmation that you're right, you will sabotage any strategy that requires patience. This is why people can understand index investing intellectually and still fail at it emotionally. The plan is simple, the execution is not. The market doesn't punish ignorance as harshly as it punishes impatience. Now we arrive at the part of the case file that most how to invest videos skip because it sounds uncomfortable. Power. Not political power, psychological power. The market is not a place where the strongest ideas win. It's a place where the strongest emotional incentives win. And the incentive that runs everything is simple: keep you either excited enough to buy or scared enough to sell. Calm investors don't click headlines. Calm investors don't churn accounts. Calm investors don't donate fees through constant activity. Calm investors are bad for the attention economy. So the system subtly trains you to confuse motion with intelligence. When your portfolio is up, you feel smart and you want to optimize. When it's down, you feel threatened and you want to protect. Both urges produce the same outcome: action. And action is the easiest way to destroy a long-term compounding machine. The paradox is cruel. Doing nothing is often the best move. But doing nothing feels like losing control. That gap between what works and what feels safe is where most wealth disappears. In Florida, the developers cashed out before the storms. In the Nifty 50 era, institutions survived because they could hold through a decade of pain. Today, the equivalent advantage isn't insider info, it's time horizon. If you can stay invested longer, you can outlast narratives. Time is the one resource the average investor gives away too cheaply. They sell years of future compounding for a moment of emotional relief. It's the most expensive painkiller in history. Let's make the danger practical. Imagine a year when the market drops 35% and headlines scream that this time is different. Daniel's $100 becomes $65. His international fund also drops. Bonds don't save him as much as he expected because rates behave weirdly. He feels betrayed, not by risk, but by the story of safety he built in his head. He starts saying sentences that sound wise but are really fear wearing a suit. Maybe I should just wait for things to stabilize. That sentence is one of the oldest trapdoors in finance. Wait for stability usually means re-enter at higher prices. It means you miss the recovery because recovery feels scary when it begins. Markets don't ring a bell at the bottom. They whisper. The first days of a rebound feel like a fake out. The investor who waits for certainty often buys back only after the narrative has flipped again, after the easy money is already gone. This is why I tell people to write an investment policy statement like it's a legal document. Not a fluffy vision board, a contract with your future self. It should answer 3 questions in plain language. What do I own? Why do I own it? What will I do when it hurts? Because the moment pain arrives, you won't have time to think. You'll only have time to obey whatever script you wrote in advance, or whatever script fear writes for you on the spot. The next twist. The danger changes as you get richer. Early-stage investors fail out of fear. They sell because the drops feel fatal. Late-stage investors fail out of pride. They gamble because the gains make them feel invincible. When Daniel's portfolio climbs to $300 or $500, the same brain that once panicked may start whispering something even more seductive. You've proven you're good at this. Why not accelerate? That's how disciplined index investors quietly turn into concentrated risk takers without noticing the identity shift. And once you cross that threshold, the 3 funds strategy becomes a stage, not a rule. People begin adding side bets, a handful of hot stocks, a leveraged ETF, just for extra growth, a crypto position, because it's the future, options, because it's smart hedging. Each addition feels reasonable in isolation. Together, they become a new Florida, Paper wealth built on the belief that risk has been defeated by cleverness. The math of blow-ups is always the same and always ignored. A 50% loss requires a 100% gain to recover. A 75% loss requires a 300% gain. That asymmetry is why avoiding catastrophic downside matters more than chasing maximum upside. Index funds are powerful precisely because they make it hard to go to zero. The moment you add leverage and concentration, you reintroduce the one thing the index was protecting you from: the possibility of permanent damage. This is where my investigation produces its most uncomfortable conclusion. The best 3 index funds aren't the real strategy. The real strategy is building a life that can tolerate the strategy. Emergency cash, stable income, low fixed expenses, a timeline that matches your risk. Those are not motivational cliches, they are structural defenses. Without them, even a perfect portfolio becomes fragile. With them, even a boring portfolio becomes unstoppable. Return to the original promise of the story. The mechanism that separates people who build real wealth from people who only feel wealthy until reality catches up. The mechanism is not genius. It's not prediction. It's not finding the best funds. The mechanism is endurance engineered on purpose, not hoped for. Florida speculators didn't lack information, they lacked staying power. Nifty 50 buyers didn't lack intelligence, they lacked patience when the pain lasted years. The winners weren't smarter, they were positioned to survive. This is why I look at Daniel's life the way a detective looks at a suspect's alibi. Where does his stability come from? How much of his monthly spending is fixed? How long can he go without income? These questions sound boring until you realize they determine whether he will be forced to sell during a downturn. Forced selling is the only true death in long-term investing. Everything else is a temporary injury. If you remove forced selling from the equation, volatility becomes weather. If you keep it in, volatility becomes a guillotine. Ellips's narration touched a nerve when he said people invest in stories. The deeper truth is that people live inside stories. Daniel's story is, I'm responsible. Maya's story is, I'm building freedom. Another investor's story is, I'm late and I need to catch up. That last story is the most dangerous because it makes risk feel like medicine. When someone feels behind, they don't want a plan that works slowly. They want a plan that works now. And now is how you end up standing in a muddy field holding a deed. The mid-story reveal that keeps the tension alive. 3 index funds can be a fortress or a trap depending on one invisible variable: your behavior under stress. When the market drops 30 to 40%, the fortress protects you only if you remain inside it. Step outside in panic, and the fortress becomes a prison you built for yourself. That's why the financial industry loves simplifications. Buy and hold forever sounds easy. Which makes you overconfident, which makes you unprepared, which makes you the perfect candidate to panic later. This is also why the phrase, long-term average returns, can be a weapon. Averages are smooth, life is not. A century of 10% annual returns can include stretches where you go sideways for a decade. Where inflation steals purchasing power. Where you feel like an idiot while everyone else seems to be winning. The average hides the lived experience. And investing is not passed by math alone. It's passed by surviving the lived experience without self-destruction. In my notebook, I draw 2 timelines. The first is the market's timeline: up, down, up, crash, recovery, boom, correction, repeat. The second is the human timeline: job loss, divorce, illness, children, housing decisions, ego, fear, envy, fatigue. The gap between those timelines is where portfolios break. The market may recover in 5 years, but your personal crisis may not give you 5 years. This is why time horizon isn't a financial concept. It's a life concept. We approach the last major turning point of this section: the difference between accumulation and distribution. During accumulation, downturns can help you if you keep buying. During distribution, when you're withdrawing, downturns can hurt you because you're selling shares at depressed prices. People who treat investing as one continuous phase miss this and get blindsided. They invest aggressively right up until the moment they need the money. Then learn sequence risk the hard way, when the lesson is most expensive. A true, best 3 funds plan isn't static. It's a system with rules that change as your timeline changes. It has a cash buffer that grows as your withdrawal date approaches. It has rebalancing that forces you to sell what's expensive and buy what's cheap. Even when your emotions scream the opposite, It has constraints that prevent the late-stage overconfidence trap, the moment you feel rich enough to start breaking your own rules. That brings us to the concept Tom called enough, which I consider the most underrated risk management tool in finance. If you never define enough, you will keep moving the goalpost until you accidentally turn safety into a new kind of danger. You'll chase higher returns when you no longer need them. You'll stay aggressive when the smartest move is to protect what you've already built. Enough isn't resignation, it's a boundary that prevents greed from rewriting your life. Here's the quiet, almost cinematic line I want you to sit with. Most portfolios don't die from one bad year. They die from one bad decision made in an emotional year. Florida died because people believed paper gains were permanent. Nifty 50 hurt because people believed blue chips were immune. Modern index investors suffer when they believe diversification means I can't feel pain. Pain is part of the price. The only question is whether you pay that price and keep the asset, or pay that price and lose the asset too. Point in the file. Most people expect a neat moral like a children's book. Be patient and you'll be rich. But real casework doesn't end with a slogan. It ends with procedures, specific actions that prevent you from becoming the next victim. So I'm going to walk you through the evidence protocol I use when someone says they're investing $100 across 3 index funds. Not because you need more information, but because you need fewer ways to betray yourself. Procedure 1 is the simplest and the most ignored. Open the fund and read the actual holdings. Not the marketing summary. People treat holdings like boring fine print. That's the mistake. Holdings are the truth serum. When you see the top positions and their weights, you stop thinking in comforting generalities like the entire economy, and you start thinking in exposures, big tech, mega caps, US concentration, currency risk, interest rate sensitivity, and the moment your brain shifts into exposures, your fear becomes less mystical and more manageable. Procedure 2 is to simulate the storm before it arrives. Not with fancy models, just with brutal honesty. Ask, what happens if my $100 becomes $70 in 6 months? What happens if it becomes $55? What sentence will my mind produce at 2 a.m. when I can't sleep? People assume they'll be calm because they're calm today. That's like assuming you'll swim well during a hurricane because you swim well in a pool. You must rehearse the panic while you're still safe. Procedure 3 is to engineer a barrier between emotion and execution. Automation is not just convenience, it's a behavioral shield. Automatic contributions, automatic rebalancing schedules, rules that require a waiting period before making major changes. These are the locks on the door. Because in the moment of stress, your brain will insist it has discovered a new truth about the world. It will call fear, insight. It will call impatience, prudence. A barrier buys you time to let that chemical storm pass. Turn to the most misunderstood weapon in investing, rebalancing. People treat rebalancing like a minor housekeeping task. In reality, it forces you to do the one thing humans hate: sell what feels safe and buy what feels scary. When US stocks surge and everything looks invincible, rebalancing makes you trim them. When international looks ugly and disappointing, it makes you add. When bonds get mocked as dead weight, it reminds you they exist for survival, not bragging rights. Rebalancing is the discipline that turns diversification from a slogan into a mechanism. Here's where the investigation takes a darker turn. Because even if you do everything right, you still face a strange modern threat: concentration hidden inside passive products. This is not a reason to avoid index funds, it's a reason to understand what passive actually means. It doesn't mean the market is neutral. It means your portfolio is weighted by market value. The bigger something becomes, the more of it you own. That's momentum disguised as simplicity. When you accept that, you stop being shocked when the index behaves like a bet on whatever has become huge. And this is the moment to bring back the nifty 50 ghost. Back then, investors didn't lose because the companies were imaginary. They lost because the valuations became a crowded agreement that safety was worth any price. Today, a similar crowd agreement can form around the largest names in the index. Even if those companies remain strong, paying too much for strength can still produce long periods of disappointment. The market doesn't punish greatness. It punishes overconfidence about greatness. Now, let's talk about bonds, because in every era, there's always an asset class the crowd calls useless. Bonds are often that scapegoat. People want bonds to make money. Bonds exist to keep you in the game. In certain periods, bonds will disappoint. In others, They will be the only reason you didn't panic sell your stocks. The real function of bonds in a 3-fund portfolio is psychological and structural. They reduce the probability of catastrophic behavior. They buy you time, and time is the most precious thing a compounding strategy can own. The trap is stealthy, the accumulation illusion. In the early years, adding money monthly crashes can improve your long-term result because you buy cheaper shares. Investors learn this and then misapply it. They start thinking volatility is inherently good. They seek higher risk, leverage, concentration, because they want more discounts. That is like a surgeon deciding more bleeding must be better because bleeding proved the body is real. Volatility is not a gift in itself. It's a cost you tolerate in exchange for long-term growth. Too much of it destroys you before it can help you. A protocol ends with one final principle that sounds almost spiritual but is brutally practical. Your goal is not to maximize returns. Your goal is to maximize the probability of a good outcome. Florida was a return-chasing story. Nifty 50 was a certainty-chasing story. Many modern investors make the same mistake without realizing it. They chase the feeling of being right. A 3-fund index portfolio, done correctly, is a strategy of survival and sufficiency, not bragging rights. It wins by refusing to lose in a catastrophic way, and by letting time do the heavy lifting while you do the hardest job of all, staying still. A final section of the case file begins the way most real endings begin, not with fireworks, but with a quiet choice. Daniel sits at his kitchen table on an ordinary night and realizes the real enemy was never the market. It was the part of him that wanted to feel safe all the time. He understands that every strategy that works over decades will feel uncomfortable at some point. Because the price of long-term compounding is short-term doubt, and doubt doesn't go away when you get richer, it just changes costumes. Meanwhile, learns a different lesson. She watches her automated contributions keep buying through a downturn and notices something strange. The more she removes herself from the day-to-day drama, the stronger she feels, not because she's fearless, but because she has built a system that doesn't require fearlessness. She stops checking the app daily. She stops treating headlines like commands. Her portfolio doesn't become a scoreboard. It becomes a machine running in the background of her life. When the market turns, because markets always do, the recovery doesn't arrive like a parade. It arrives like an awkward sunrise after a long night. The first good months feel suspicious. People don't trust them. They demand proof, stability, certainty. They want the story to be safe before they re-enter. And that's why most people miss the early recovery. They aren't late because they're stupid. They're late because their nervous system needs permission. In my files, this is the exact point where the Florida pattern repeats. Not the land, not the deeds, the timing. The public sells after the storm, then buys after the calm returns, which is usually after prices have already risen. It's not a moral failure. It's biology. Your brain evolved to run from threats and chase safety. The market, in a sense, monetizes that instinct. If you want to escape the trap, you have to stop treating instinct as guidance. The most powerful investor skill is not analysis, it's humility. Humility says, I don't know what happens next, so I diversify. Humility says, I can be wrong, so I build buffers. Humility says, I will feel panic, so I design rules in advance. The Nifty 50 era punished arrogance disguised as certainty. The modern era will punish the same arrogance, even when it's wrapped in a passive index label. The story reaches its real climax when Daniel is tempted by the final, most seductive lie. I've earned the right to take more risk. His account grows. The numbers get big. The pain of the crash fades. He starts to believe he's different now. That's when he rereads his investment policy statement and sees a line he wrote in calm handwriting. When I feel invincible, I will do nothing. He laughs at how dramatic it sounds, and then he realizes it's the most valuable sentence he owns. Because the market has two favorite ways to break people. First, it scares them out early. Then, if they survive that, it flatters them into recklessness later. Early failures come from fear. Late failures come from ego. The winners are not those who never feel fear or ego. The winners are those who treat those feelings like weather, real, temporary, and not worth rewriting a long-term plan. What happens to the $100 across the 3 index funds? The answer is less cinematic than people want and more beautiful than they expect. Over years, it grows, sometimes quickly, sometimes painfully slowly, sometimes not at all for stretches that test your faith. It grows not because you predicted the right year to buy, but because you kept showing up when showing up felt pointless. It grows because you avoided the catastrophic mistake of turning temporary losses into permanent ones. Here is the mechanism. Stated plainly, like a detective closing the file, real wealth comes from owning productive assets for a long time while resisting the urge to interfere. Florida investors thought flipping paper contracts was wealth. Nifty 50 buyers thought paying any price for safety was wisdom. Many modern investors think 3 funds is a magic spell that eliminates pain. The people who become truly wealthy are the ones who accept the pain as rent, pay it on time, and keep the building. A ellipsed page of the file isn't a forecast. It's a warning and a promise. The warning is that the next swampland scheme will not look like a swamp. It will look like something responsible, popular, and obvious. The promise is that you don't need secret information to win. You need clarity about what you own, rules for what you'll do when it hurts, and enough humility to let time work. Because in the end, the game rewards patience and punishes activity. And if you can master that, if you can stay the course when fear screams and ego whispers, your $100 won't just grow into a bigger number. It will grow into the rarest asset of all, freedom.